Ever wondered why your Forex trades keep going against you? It's a question that echoes in the minds of many traders, seasoned and novices alike. It's like a game of chess where you seemingly can't outsmart your opponent. The market, an ever-shifting, unpredictable beast, seems to have the upper hand. But why? What's leading to this unfortunate cycle of losses that feels like a never-ending spiral? Well, you're not alone. Let's delve into the precise reasons why this might be happening. One of the primary reasons trades go against us is due to a lack of proper analysis. This is not about merely glancing at a few charts or following the crowd. It's about understanding the market, its trends, and the factors that influence it. Imagine you're an explorer in a vast unknown territory. Would you venture forth without a map or any knowledge of the landscape? Probably not. Similarly, when trading Forex, the market is your territory. And going into it without a thorough analysis is like wandering in that unknown territory without a map. You're setting yourself up for failure. Trading based on incomplete information is akin to walking on a tightrope blindfolded. Yes, you might make it to the other side, but the risks are high, and the fall can be devastating. Thorough market analysis provides you with insights that can guide your trading decisions. It helps you identify profitable opportunities and avoid potential pitfalls. So don't just place trades based on a hunch or a hot tip. Take the time to analyze the market, understand the trends, and make informed decisions. Remember, in Forex trading, knowledge is power. And that knowledge comes from thorough market analysis. So remember, thorough analysis is not an option, but a necessity for successful trading. Another pitfall that traps many traders is overtrading. Overtrading, as the term suggests, is the act of making excessive trades in a bid to recoup losses or chase profits. It's akin to taking a high-stakes gamble, where the odds are stacked against you. Why is overtrading a problem? Well, it's simple. The more trades you make, the more exposure to risk you invite. Each trade carries a potential for loss, and by increasing the frequency of your trades, you're also increasing the likelihood of experiencing losses. It's a recipe for disaster that can wipe out your trading account in no time. Instead of focusing on the quantity of trades, successful traders understand the importance of quality. They know that it's not about how many trades you make, but how profitable those trades are. They take time to analyze the market, make informed decisions, and wait for the right opportunities. It's a game of patience and precision, not a frantic race. So, the next time you're tempted to place just one more trade, think again. Remember, overtrading is a pitfall that can lead you down a path of continuous loss. Always prioritize quality over quantity to protect your capital and maximize your profits. It's not about making the most trades, it's about making the right ones. One can't stress enough the importance of risk management in Forex trading. It's the safety net that catches you when the market takes an unexpected turn. It's your insurance policy against catastrophic losses. You may be thinking, I'm a smart trader, I've got a good strategy, I don't need risk management. Well, that's where you're wrong. Risk management isn't just for those days when the market is volatile, or for those trades that don't quite go as planned. It's for every single trade you make. It's about setting appropriate stop-loss orders to limit your losses. It's about having a clear exit strategy, so you know when to cut your losses and when to take profits. It's about managing your capital wisely, so you don't put all your eggs in one basket. Ignoring risk management is like driving without a seatbelt. Sure, you might be fine for a while, but when things go wrong, they can go very wrong, very quickly. And in Forex trading, this can mean significant losses that could wipe out your trading account. Remember, risk management isn't just about preventing losses, it's about ensuring your survival in the trading world. This is not a game of chance, my friends. It's a game of strategy, discipline, and above all else, risk management. Last, but certainly not least, is the danger of emotional trading. Emotions, they're what make us human, right? But in the world of Forex trading, they can be your worst enemy. Fear and greed, these powerful emotions, have the potential to cloud your judgment, leading you down a path of unfavorable outcomes. Imagine this. You're on a losing streak, fear starts creeping in, you panic, and instead of sticking to your plan, you hastily exit the trade, only to see the market reverse in your favor moments later. Or perhaps you've had a few good trades and greed takes hold. You start overtrading, taking on more risk than you can handle. And then the inevitable happens, the market turns, and you're left with losses that could have been avoided. This is why it's essential to keep your emotions in check. Trading shouldn't be a roller coaster of highs and lows, but a calculated process of making rational decisions based on thorough analysis and sound risk management. It's not about chasing the thrill of the win, but about consistently making wise, informed decisions that will lead to long-term success. So, the next time you feel your emotions taking the driver's seat, it's time to step back and reassess. So why do your Forex trades keep going against you? We've journeyed through several key reasons. A lack of proper analysis often leads traders to make decisions based on incomplete information. Overtrading, too, can heighten risk and amplify losses. Ignoring risk management, like not setting appropriate stop-loss orders, can cause significant losses. And let's not forget emotional trading, where fear or greed can cloud judgment and lead to unfavorable outcomes. Avoid these pitfalls, and you're well on your way to turning the tide in your favor. Happy trading!